3% of business owners self-educate. Only 2 to 3% of business owners buy business-related books to get better. So just by the fact that you're here puts you way above most of your competition. The fact that you're diving into these books is going to create wonders for your business. In terms of mindset, in terms of self-discipline, in terms of the mirror, John Maxwell's latest book, just released, The 15 Invaluable Laws of Growth. Fantastic book. If you want to grow, if you want your business to grow, you have to grow. Because your business is a mirror. My business isn't where I want it to be, that means I have to grow somewhere. Financial. Understanding the vocabulary of your financial statements is important to be able to know the score, right? Because your financials are your scoreboard. It tells you whether you're winning or losing the game. Financial reports. Break even and management decisions. Do you know where your break even is? We're going to talk about that. Break even is not as simple as you might think it is. Valuation. How valuable is your business right now? Do you know where your business is from a valuation? If you were to sell your business right now, do you have an idea of what you could get for it? If you don't, think about it. Because most businesses will sell for some multiple of EBITDA. If it's a commodity type of business, it's going to be a lower multiple, like maybe 2. If it's a technology business, it'll be a higher multiple, maybe 7. There were, back in the crazy days of the 90s, there were IT businesses selling for 15 times EBITDA. So understand what your business value is and then set some goals to increase that business value. Your balance sheet is really, really important in giving you a picture of your business value. So understanding your numbers leads to greater confidence in your decisions. Have you ever made a decision where you really wished you had had more information and regretted the decision? I have. Anybody else? Yeah, so make decisions based upon the numbers. It helps to take the emotion out of the decision when the numbers are there. And it also informs those decisions. It improves your discipline, your decision-making discipline. You know, decision-making is a discipline. There are people that ready, shoot, aim and make their decisions that way. And there are people that actually calculate the pros and cons of a decision and have a number of options available. Which one do you think is going to make the best decision? Absolutely. Logic-based choices. That's the other thing the numbers do. It helps improve your logic in terms of making those choices. Dan was talking about awareness in terms of your reticular activating system. Greater awareness of your abilities. If you understand your numbers, you're going to see where are your abilities as a business and as a business owner strong and where are they weak. It'll show up on your financial statements. Proper examination of the issues. Understanding every business has constraints. Did I bring that book? Yes, I did. This is a great book for understanding the theory of constraints. This is called The Goal. This book is a novel. It's an easy read. It's a novel that teaches very profound lessons. And this book is used in some of the top MBA courses in America, including at Harvard and the Wharton School of Business. It's a thick book, but it's a quick read. It's a fantastic book. It talks about the theory of constraints. Every business has constraints. And every time you identify those constraints and relieve those constraints, you grow until another constraint manifests. Identifying that constraint and relieving that constraint, you grow again. So it becomes a series of constraint identification and then relieving. So proper examination of the issues is all about relieving constraints. Effective billing, collecting and paying. Ooh, anybody here ever encounter a cash flow problem in their business? I sure have. in my many businesses that I've been involved with in history. Cash flow is oxygen to your business. You can go without food for a while. You can go without water for a while. But run out of cash. More businesses go out of business due to cash flow than any other reason. It's oxygen. And maximizing the value of your company. If you're not measuring it, you can't improve it. Cash. That's one of the ways of accounting. Cash basis of accounting. A lot of CPAs, especially tax CPAs, like cash accounting methods because it's a lot easier, it's a lot simpler. Keith Cunningham says the only business that should be using cash accounting are either the drug business or the prostitution business. Because they're pure cash. Because the difference is cash accounting, income and expenses are recorded only at the time the money changes hands. You cannot run your business on that basis. You get a deceptive, distorted picture of your business. Accrual basis accounting is the type of accounting you want in your business. That's where income and expenses are recorded at the time they are incurred, not at the time the money changes hands. There's two parts of every transaction. There's the promise and there's the delivery. Cash accounting only accounts for when the cash is delivered. Accrual is based upon when the promise is incurred. When you get a purchase order, that's booked as a sale in your revenue. That's why you need three types of statements to run your business. You need P&L, you need a balance sheet for your assets, and you need a cash flow statement so you know where your cash is. Cash and profits are different. I can't tell you the number of times where P&L shows up, oh, we're profitable, but there's no money in the bank. How does that happen? Because cash and profits are not the same. We'll talk about that. Tax accounting is backwards looking, follows tax rules. It's intended to report to the government and generally done by trained accountants. If your accountant is purely a tax accountant, find a business accountant. Got one right here. Don Armstrong. It's part of the Diamond Payroll business suite. They do a lot of business accounting. They understand the principles I'm talking about. Managerial accounting, forward-looking, used by managers to make decisions about the future. Cash flow pro formas, very, 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 very important to see what your future looks like, to avoid the cash flow pitfalls that could be coming. So let's talk about vocabulary. Revenue is income generated by sales. Cost is an outlay of funds made in anticipation of a future benefit versus an asset. It's an expense. An asset is not a cost that shows up on your P&L. That shows up on your balance sheet because you're buying a permanent asset. Now, that asset over time gets used up, right? And that's called depreciation. Depreciation shows up on your P&L because you are using up that asset. And the idea with depreciation is when you see depreciation on your bank, on your P&L, you need to be chunking cash away to replace that asset, at least based upon the amount of depreciation that you're experiencing, so that you can replace that asset when it is used up. You choose the speed at which you depreciate an asset. Some assets lose value quicker than others. Some assets, like in a manufacturing arena where there's a lot of wear and tear on the asset, that depreciates pretty quickly. Or in the IT business, if you have a computer, what's the average life of a computer in terms of value to the business in today's economy?
6 weeks.
That's 3 years. That's right. 3 years is the average. So make sure that you're depreciating that computer at least over 3 years' period of time, and then chuck it away to cash to buy it again, replace it. Profit is expense subtracted from revenue. That's all profit is, expense subtracted from revenue. And depreciation is an expense, isn't it? Is it a cash expense? No, it's not a cash expense. It's a non-cash expense. That's one of the reasons why cash and profit aren't the same. Variable expenses. These are expenses that go up and down in proportion to your production and your sales, aka direct expense. Those are the expenses that get subtracted from your sales and gives you your cost of goods, or in your cost of goods sold, gives you your gross margin, your gross profit. And then your fixed expenses, those are expenses that don't go up and down in proportion to production and sales. Your overhead, your rent, your insurance, your salary as the owner of the business, your sales, if they're salaried, your management, your administrative, your accounting. Those are all overhead. That just happens regardless of how many sales you make. Gross margin derived from gross profit, and it's gross profit divided by revenue. It's the difference between your revenue and your COGS, your cost of goods sold. Talked about that. Contribution margin, difference between revenue and variable cost. Contribution margin is only variable cost. I don't want to confuse you because some cost of goods sold can be non-variable costs in certain situations. Contribution margin is only variable costs. Break even. You're neither losing money nor you're making money. And that's the point where your contribution margin equals your fixed expense. That's your break even. I'm going to show you an actual example how you can calculate this. P&L, profit loss statement, revenue and expenses occurred during a statement period of time. It's not an instant, it's a period. It's like a movie. Balance sheet compares what a company owns to what it owes at a specific point in time. That's a snapshot. So your P&L is like a movie. You can look at your P&L and you can see how that records the decisions that you've made over that period of time. You can have a monthly P&L, a quarterly P&L, a yearly P&L. You can look back and see how your decisions impacted your business. Balance sheet is an instant in time. It compares what you owe to what you own. Okay. Here's what happens many times when I have a P&L produced by just a cash accounting or a tax accountant. They take the revenue, they list all the expenses, subtract it from the revenue, and that gives you your net profit. So let's say you had $125,000 in revenue, and you generated a total expenses that year of $120,000, which leaves you $5,000 left over. Pretty simple concept, right? Everybody get that? What's your break even? What do you think your break even is?
With $125,000 in revenue, $125,000 in expenses. Right?
Believe it or not, you can't tell.
Because your cost of goods are not going to cost of goods.
Because your variable costs and your non-variable costs are mixed. You really can't tell your break even. I'll show you why. Here's a scenario that actually gives you that visibility. Let's say you're a business that has two product lines. $50,000 in revenue from product line number 1 and $75,000 in revenue from product number 2 gives you a total of $125,000. Your direct material costs are $25K for item 1 and $50K for item 2. 50% of your sales for item 1 and 67% for item 2. And then your labor, direct labor, $4,000 for item 1, which is only 8% of your revenue, and $18,000, much more labor intensive to produce item number 2, 24%. Total gross profit is $21,000 for item 1 and only $7,000 for item number 2, 42% versus 9%. Did you have that visibility on the previous statement? No. Do you see how this has given you some clarity about your product mix? Which one do you want to sell more of? Item number 1, right? You don't get that with a tax accounting kind of P&L. So your total gross profit is $28,000, and your gross margin is what? What's your gross margin? What's your gross margin? 22%, that's right. Your gross margin is 22%. Now your fixed expenses total $23,000. Those are expenses that you have regardless of how much you sell. Look what your break-even is. How do you arrive at $104,545 for break-even? I'll tell you how you do that. The way you arrive at that, what your gross margin of 22% is telling you is that for every dollar of sale, you have 22 cents left over after you've delivered your sale, your product. You've got 22 cents left over to cover your fixed costs, your overhead. Do you understand that concept? Please, if you don't, raise your hand. This is really, really important. Because you can't calculate your break-even if you don't understand this concept. That's what gross margin is telling you. It tells you how much money out of every dollar you've got left over to cover your overhead, your fixed expenses after the sale. So you take that 20, if you've got 22 cents out of every dollar left over, how do you calculate your break-even?
Multiply your gross revenue or your net profit. I mean, not net profit, your gross revenue times.
That'll tell you, well, that'll give you your gross profit. What you do is you take that 22 cents, when you're breaking even, you've covered your fixed costs with nothing left over, right? Isn't that the definition of break even? So if you take 23, anybody got a calculator? Take 23,000 and divide it by 0.22. That's how many times 0.22 goes into covering your fixed costs, which tells you how much money you got to have to cover your, how much money from sales you got to have to break even. How much is it?
104,545 is what you got right there.
Isn't that interesting? You see how that works? So, what that says, based upon this scenario, that you've got to sell $104,545 worth of goods to break even, right? You see how you could, there was no way possible you could know that from the previous financial statement. Everybody get this? If you don't, please raise your hand, because I'll go over it till you do. This is a really important concept, because you got to know the score of your business. Now I'm going to show you something else, pretty cool. You can actually lower your break-even. The knowledge that you have here, you can lower your break-even with the same amount of sales. How do you do that? That's one way.
Yeah, change the items that you're.
That's right. Yeah. You can actually increase your profits by stopping doing something. Isn't that amazing? See how this works out. We just say, okay, we're going to dump product number 2 and focus on product number 1. And that's all we're going to sell. So you sell 125,000 of product number 1. You eliminate product number 2. Same amount of sales. Look what your gross margin did. It jumped from 22% to 42%.
Yeah, provided you have customers from number 1.
Pardon me?
Provided you have enough customers to sell.
That's right.
125,000
Yeah.
of number 1.
Exactly. You have to be able to generate the revenue from that.
But you're spending your time and your resources and your staff, et cetera, to sell that item too.
Excellent. Focus.
So you can actually sell less of item number 1, still make more money.
Did you catch that?
Can I say that again? We didn't hear you.
You can sell less of item when you put all your resources into selling item number 1. You can sell less of item number 1, make more profit.
Yeah, because you have less overhead. Right?
No, you have the same overhead, but you got greater gross margin to cover it. So you could sell less. And the reason why is because look what your break even is. It's half. at your profits. Did they jump from 5,000 to 29,500? So anything in between there is still more money, isn't it? So you could ratchet that down. You could sell, somebody run the numbers, $100,000 of sales minus 23 in $100,000 minus 52.5. What is it? Minus 52.5 minus 23. 24.5. That's still a little more than 5,000, isn't it?
Some of your variable costs are gonna go down if your sales are really gonna be more.
It's actually right. Thank you for that. Yeah, actually it's going to be more than that because your variable costs are really a percentage. I should have taken 42% of 100,000. Should have subtracted only, thank you for that, 42,000. Subtract 42,000 from 100,000. What do you get? 58,000. 58,000 minus 23, 25,000. So now you had less sales, but 5 times the profit.
Yeah, it's kind of like that business chassis and the 5 ways in each one of those deals and increasing it by 10%.
Exactly. Exactly. So do you see how powerful having this visibility is for your business? Knowing what your profitability is in each of your areas. Whether you're a product business or a service business, you can do this. Knowing where your margins are. Powerful concept. Anybody got any further questions on that before we move on? Okay. Your profit increased almost 600%. Cash required dropped from 120,000 to 95.5 thousand. So $95.5 thousand is what you would require to break even. Profit is not cash in the bank. Reason why, you've got accounts receivables. Okay. Now, how does account receivable show up on your P&L? It's income. That's exactly right. Your accounts receivables are listed as income because if you're using accrual accounting, it's booked when the transaction occurs, not when the money changes hands, right? So accounts receivable is a non-cash item showing up on your P&L as income because you don't have the money yet. Okay? Accounts payables, that's a reverse. You can boost your cash position by slowing up your accounts payables, right? Assets purchased. If you purchase a new vehicle, that whacks your cash if you pay cash for it, right? It doesn't show up on your P&L until you start depreciating. But then it's just small chunks. Assets sold. The reverse. You sell a vehicle, or you sell a machine, and you put that money in your bank. All of a sudden, wait a second, I had 10% profitability this month and no money in the bank. 10% profitability this month, I got all this money in the bank. What happened? See how the P&L doesn't tell you what the cash position is. Borrowed money. Some of us borrow. Anybody have a line of credit for their business to take out the cash flow cycles? See, the line of credit doesn't show up in your P&L, but it takes out those cash flow dips. Repayment of borrowed money, that hits your cash because you're paying back, but doesn't show up on your P&L with depreciation. Business valuation, what's your company worth? I want to talk about this a little bit. Value comes from future income, and future income comes from 2 places. The value of your business to a potential buyer is dependent on not what you, well, the history is important, but the reason why that purchaser is interested in buying your business is not because of what you've done in the past, it's because of what they think they can do in the future, right? It's future income that determines the value of your business. And it comes from 2 places. Sale of assets. Okay? Many people sell their business, unfortunately, as an asset sale. Their business, the worth of their business is the sum total of all their depreciated assets. That's a pretty poor picture. It's not very good. Sad. And that happens more times than not, because they don't understand that they're working on a masterpiece, they don't have an exit strategy in place. The second is future earnings from continued operations. That's what you want. You want to be able to convince your buyer that there's great future earnings from continuing to operate the business. That's how you maximize your sale price. So how do you generate that picture? Well, let me show you an analogy. This is a thought process that every one of us has gone through at one time or another. Let's say we put $1,000 in a CD. Okay?
No thanks.
And let's say the interest rate is 10%. There was a time when that actually did exist. Okay? So for us old folks, we can remember that. Okay? What's your return? What's your annual return on that and putting that $1,000 in a CD? $100. Your annual return is $100. So that's why you're willing to exchange that $1,000, use of that $1,000. You're willing to delay the use of that $1,000 so that you can generate $100 a year from it. It becomes an income generating instrument for you, right? That's why we do an investment. Okay? What if we reverse this? Let's say that you wanted to establish an annual future income of $100 a year from your investments. Okay? And you wanted to generate 10% return. That's what your requirements are, 10% return. What would you be willing to pay for that instrument? $1,000. That's exactly right. You'd be willing to pay $1,000 under those criteria. When somebody's buying your business, they're going through this thought process. I want a certain amount of return on my investment into purchasing this business. And I want that return within a certain period of time. And they just work backwards to create the value of the business. Does everybody get this? So how do you establish that return? What that looks like? You trend your EBITDA. That's one of the ways. You trend your EBITDA. You establish what your balance sheet looks like, your assets, your goodwill, the marketing that you've done. All of that contributes because your EBITDA will be multiplied by some multiple that'll match their desired rate of return. Now that desired rate of return is dependent upon their other alternatives in business, right?
Okay, I have a quick question.
Sure.
Okay, the multiple though, is that just determined by the market as a whole?
Mm-hmm.
Okay.
Exactly, because 10% return right now is considered pretty good, isn't it?
Right.
15 years ago, not so. So it depends upon the economic situation. So 15 years ago, people were willing to pay a higher multiple of EBITDA for the business because they got a better return. Okay, any other questions? Okay, let's look at page 17 or page oh wait, no, that's right. I'm sorry, page 17. That's exactly right. Okay, page 17. Remember, go down these questions for money mastery. Yes or no, and then put a check mark in what quarter you want to work on this.